Buenas tardes en Europa y buenos días a nuestros clientes del otro lado del Atlántico.
Good afternoon, Europe. Hello, everybody on the other side of the Atlantic. This is a wealth talk. This is for our private banking customers, and we have experts with us who will address issues such as economics, economy, science, society, innovation. But today we're going to talk about something new, 2023, the year of disinflation. We have with us Juan de Dios Sanchez Rosalie, our CFA, Global Chief Investment Officer, Alfonso Garcia Ubero, Analysis and Strategy, Santander Private Banking Spain, and Nicolas Perez de la Blanca, Chief Investment Officer, Santander Private Banking International. They are with us, and some from Miami. We're going to talk today about what's happened recently over the past 2 months, more specifically, ever since we launched our investment outlook, and that was back in November 22. So, Juan de, let's take a look at the main messages of this global marketing outlook, the great adjustment. So my first question for you is rates. Rates. Are they the most important variable for 2023? That's my question. My answer is hello, good afternoon, good morning. Actually, it was most important in 22, but with the negative, we had an inflationary shock. The rates rose, and this, I think it's fair to say, affected all economies, all developed economies. Economic stakeholders and agents suffered the impact of 3 to 5% increases, and in Latin America, Brazil, Chile, Mexico, an accumulated hike above and beyond 10%. 2023 is a year, we believe, in which interest rates are going to continue to take center stage, but in a positive way. We expect stabilization that will come hand in hand with what we talked about in our document, the three Ps. Inflation peak, pause in hikes, and pivot because we pivoted. That was a slow landing, if you will. We believe that the year has begun in a positive manner, and this with regards our roadmap, and perhaps more especially with regards the first of the milestones. Inflation is definitely allowing us to understand that it has hit the ceiling. You talk about good surprises, happy surprises. What underlies that excellent commencement in January? Let's take a look here. Well, the year has begun with a boom. We have seen in many markets the best ever January, one of the best ever. We see how fixed income and variable income evolved over 22. Let's not talk about that. We want to proceed and surpass 22. And this year, our behavior, our market performance has been just the opposite, with increases of over 7% fixed income. So what can we say here? Look at that, 7.1 and 3.3. We've seen how these markets, fixed income, have evolved, and equity too. Surprises with regards growth, that has been of great help vis-a-vis activities in the equity markets. Okay, so let's organize this and let's talk about those positive surprises, inflation, growth over the coming few minutes. Let's go to the United States. Nicholas, in this chart that we're sharing, we see inflation descending, different headings. So talk to us about what's happened. Tell us about inflation in the U.S. Tell us what you expect for the upcoming months. Christina, thank you. As we pointed out last year, inflation, and there were different components involved, spelled a reduction. So P&S, which was most affected by coronavirus, supply chain issues, that was the first to peak. That was in March, and then we began to see how it launched a downwards turn. Then second was energy and foodstuffs. That was a peak that we saw in June, July, and we're beginning to see a slowdown. And then what we now are most concerned about is services. Inflation in the services sector, which is shrinking, but which continues to be higher than what we had expected. So you can see these news. You see on the right-hand side, fuel, auto. If you think about evolution, we see the different colors. We see that green in December, and probably it will continue to be green and improving over the upcoming few months. As to wages, it's not a component itself of inflation, but it definitely points the way. Services-wise, it is, of course, very, very important in terms of inflation, including housing. So with housing and without housing, rather high. And so this inflation in services, housing, and other factors, well, this is why it continues to be up high. In general terms, I think it's fair to say that this year we're going to be seeing shrinking inflation levels. Now, the question here, and this is what we're concerned about, in the second half of the year, when those base effects disappear, and remember, please, in the first part of last year, we saw growing inflation levels, actually nearly 9.4%, but in the second half of the year, inflation began to reduce, to shrink, and we begin to see those levels that we can actually reach. But in general terms, it's fair to say that inflation is on the downswing. Thank you, Alfonso. Now let's look at the Eurozone. Let's see this same chart. What would you say about inflation? Because what we seem to be seeing is a delay if we compare with events in the US. Good afternoon, Christina. Good morning to our customers and friends on the other side of the Atlantic. As you rightly say, in the Eurozone, we have lagged behind. In Europe, inflation has had a different component to the ones in the US. It's been a supply shock. Let's remember, please, that the year had an interannual of nearly 9%, that 5.2, that's the maximum ever since we saw the euro in motion. So these are numbers that the European Central Bank is going to have to really think about. Now, headings. Well, it's very similar to what we just saw in the US. Energy, yes, of course, absolutely essential to explain current events. Services also, we see less of a bottleneck. And that makes sense because as time passes, as everything returns to normal, pandemic-wise, well, we see how many sectors in the tertiary sector adapt. This is a positive thing. And then there are doubts as to more exogenous events. This is, of course, very much depending on the war. These are the components that we're going to be seeing. This is what we're going to be seeing. And inflation, you ask, here and looking forward. Well, this part of the year, we're going to continue to see tension because at the end, there are many contracts, which are energy contracts, which are annual, and prices are determined at the beginning, and we're going to be stretched. From that point onwards, we're going to probably be seeing, and we're looking at the statistical reflex, we're going to be seeing moderation in terms of fuel. The invasion of Ukraine was in February, and the peak was hit in June. So that time period is going to see an increase in the slowing down of inflation. We're thinking about maybe 5%. And then second half of the year, well, more doubts. What's going to happen to foodstuffs and what's going to happen to wages? It is true that we're not really seeing major tension, that growth of 9% aggregate wage-wise. But remember, in Europe, trade union negotiation has much more of a presence than in the US, and also there's a slight lag with regards to inflation. So this is why we are going to be seeing a renegotiation, but we don't believe that there's going to be any excess. This is what we saw in Germany. And remember, we actually discussed this when we spoke in November, the investment outlook. At the end of the day, the German trade unions have been successful with regards to those wage increases, but 50% of what they were asking for. So we're seeing deceleration until the middle of the year. There will be more doubts, but we believe that at the end of the year, we'll be seeing 3%, and that is a yearly average, which is equivalent to 5%. Thank you. So we conclude then that this first milestone of the peak in the two more important parts of the world, the US and the Eurozone, is what it is. And what we're going to see now, after inflation, growth. Again, Nico, back to you. And I think that the question that we need to pose, we're thinking about the US here, is the labor market. We saw publication of data just last Friday, looking at January, and it really surprised analysts and the market. Tell us, why is the market so robust? What is it about these data? My answer is that the more recent data, not the final one, which was surprising, but the trend that we've seen over the past 4 months is a labor market that is truly robust. We don't see anything that would hint at a possible recession 12 months into the future. One of the reasons why this market is so strong is because of supply. We see that there's been an increase, slow, but an increase, and it's still under the levels that were in place right before COVID, which means that companies now need to hire. So the vacancies, as you see, 1.9 per unemployed person. Because of these very low unemployment rates, 3.4%, which is really the minimum. Ever since 1969, the market had never been this strong. Well, the result is that companies now, because of these excellent data, which Juan de talked about, well, they need workers. They need to employ workers. This is good for consumption. This is good for growth. But if we look at inflation, if you think about services, well, inflation there would explain how this labor market is going to make things complicated, and maybe forward-looking, we're going to be seeing long-term reductions, thinking about the Fed, the Federal Reserve. And Europe, Alfonso, back to you. The surprise is very different. Remember in November and December, the concerns, the fears, what we read about was not sufficient gas, possible cuts, rationing. What is the thought here? What is the market like? What is the energy market doing? Thank you. I have to say that last year, we were very lucky. There were black swans. In the case of gas specifically, 3 factors have aligned. First, luck. We've had a very mild winter in Europe. And then there's discipline. So despite the shortage, these are things to take into account. We did make a huge effort. We looked for alternative sources and as quickly as possible. So I have to say that we have been very, very pleasantly surprised. And then consumers and entrepreneurs, especially consumers, the consumers have really been very focused. They have self-rationed. So fortune, discipline, and the role, of course, of government subsidies. In the case of Spain, we've seen that. We've seen how these aids and subsidies have palliated part of that loss of purchasing power and the shortage of energy. That's been very important. But looking forward, we believe that we will not be having problems until April, but after April, especially when we see Germany needing to top up. Russian gas is beyond the scope. There's activity in northern fields. And it is true that time is our best ally. If you think about LNG, Spain, of course, Spain is very fortunate because we have a very solid infrastructure. But then in the summer, let's see, we're going to be seeing shortages, but not the kind of shortages that we had gloomily forecast, but there will be volatility. So we're seeing growth. At the end of the day, gas is absolutely essential for many industries in Europe. Leverage, especially is the case in Germany or Italy, where steel, auto, chemicals, heavy industry, well, they are energy dependent. So we saw the photograph, we saw that it's 20% less. So we should be, I think, happy with what we've achieved so far, but we mustn't sleep on the laurels. We need to continue to advance, we need to diversify, look for alternatives. But I have to say that the real exam that we were going to have to sit this winter, well, we've sat it, and I think that we're going to get much more than a passing grade. Well, thank you for that. So I think we need to continue to transition energy-wise. It's very important. Absolutely. Europe was the region which had most advanced along those lines with the objectives 2030, 2050. Well, we've seen recently how it's been passed by Asia and by the States, but there is no turning back. There is no turning back. Au contraire, we're going to have to really think about what Schumpeter had to say, and which we can apply to the energy sector. A lot of capacity has been destroyed. Many sources that were traditional are now being contemplated, but I think that at the end, the results are going to be good. And then, well, the energy infrastructure, of course, is going to be absolutely essential over the coming 3 decades. Thank you. Well, now let's go somewhere which is very far away. That's China. Juan de, in China, we were surprised when the government said that it was going to forego its zero COVID policy. So how is that going to affect China? My answer would be that this decision doubtless is going to have a positive repercussion in the sector, and this sector had been punished, really, because there was intermittent contagion in China, and this resulted in different types of responses, and this has slowed down growth in China over the past quarters. 22 has been a bad year for China. So this radical change in the policy, this zero COVID, is going to have a cost in healthcare costs, but in economic terms, it's going to allow for a reactivation. And we can see commercial flights, for instance, that's a good proxy for the degree of activity, for the degree of mobility of Chinese consumers. And we've seen the numbers, the statistics of visitors, and we saw that to celebrate Chinese New Year. So all of the economists are, in general, looking at an acceleration, a warming up of activities. So that's going to be excellent. This is going to definitely add value. So we've seen that focus of uncertainties being really cleared up. So the conclusions then are we have looked at energy, we have looked at China, we've talked about those 2 very important chapters. But if you remember our central scenario in our market outlook, this was a scenario in which we're not looking at a deep recession in developed countries. We're thinking about growth that will be close to zero, and probably in other quarters we'll be seeing negative growth. Now, the question that comes to the fore is, after these surprises, is it possible to avoid a recession in developed economies? Back to the U.S., back to Nicholas. What can you say? What is the outlook? What does your team think? What do you think about in the U.S.? What do you expect? My answer is, for those persons who don't know, 70% of growth in the States is directly related to consumer activities. So families and individuals, we need to know, because only thus will we be able to see whether it slows down. We can see that the savings rate in the U.S. is, at this point, negative, and that's why it's in red. You see that on the screen. As of the year 2000, we only saw something similar from 2005 to 2008. Remember what that was? That was a recession. And what we believe is that families, because the labor market is so strong, well, it could seem to be that families now can continue to consume forward-looking. They can continue to buy. So inflation is as where it is in the services department. But this activity is due to not really the wages, because if we adjust for inflation, that would have been negative, or by the savings rate either, because that, again, we see is negative, especially the one that is directly linked to the checks that were issued by the Biden government to stimulate economic growth. So consumers, if we look at the sum total, it was a positive number yesterday, but we're concerned about the future because at this point in time, consumers continue to shop, continue to buy, but forward-looking, the stimulus checks have already been spent, so forward-looking in the States, we're going to be seeing other activities. We know that in the short term, we can't really say that nothing will happen, but this soft landing that the Federal Reserve had talked about by the end of 2023 calls for growth in excess of 0, but less than full potential of 2%. We believe that it's actually quite feasible. Thank you. And back to the Eurozone and Alfonso. We have just finished 2022, and the data have gone sort of from less to more. What this chart shows us is entrepreneurial confidence, business confidence. What are your thoughts? What are the good drivers? What is your vision? Well, thank you, Christina. And as you rightly point out, this was surprising last year. In the summer, practically there was practical consensus. Everyone forecast a recession by the end of the year. So we've been positively surprised. But your question, when you ask about recession, yes or no, as Juan said, I think that what's most important for 2023 is those 3 Ps and not that capital R which loomed last summer. We do believe that Europe is going to achieve a slightly negative growth. That's going to be what it's going to be tiptoeing around, flat or slightly negative. And there are factors which would explain that a contraction would be superficial. And then there's families. Savings have shrunk as months have passed, but there's sufficient money saved. Company-wise, if you think about the rates which were so low, well, they've been able to finance themselves comfortably over the past few years, and they are not going to have to issue paper, and that's going to give them muscle. But it's very important also to remember global value chains. This is very important. So although companies will self-fund, we're going to be seeing a very fluid element. Fiscal policy now. We do believe that it's going to be slightly expansive. It's going to ease. This year, we're going to be seeing the execution of next generation EU funds. That is going to be definitely an explanation. And then the labor market. Well, the pandemic here has had some negative effects. But in the labor market, if you think about how companies actually go about balancing out supply and demand, well, there are advantages, and companies are going to be able to maintain a cost structure because they'll be able to avail themselves of more flexible formulas, flexi working, hours worked, and this is definitely going to have an impact. And we're going to be seeing less jobs destructing than during other cycles. So in Europe, there might be a contraction, but it's going to be a mild one. Now, the economies, the ones that are most leveraged, are the ones that are going to be most sensitive. So yes, here we will be seeing Germany contracting further, Italy contracting further. But as Juan said before, we do have a jack of all trades available, and that's China opening up. For Germany, that's going to be essential because it is an economy that really looks abroad. And then a couple of words about Spain. In Spain, in 2023, as in 2022, we are growth leaders. And this is because of energy. Again, I repeat, Spain is different from other economies. And then the services sector, which was, of course, something that dragged us down. during the pandemic, but now we're back to normal, it would seem, and we hope that we're going to be normal for a very long time, and that is going to be extremely advantageous for our economy. Juan Day, Alfonso talked about positive elements of the reopening of China for Germany's purposes. Tell us about your forecast, growth in China, the consumer, other sectors of the economy, and how could that fit within this scenario of global growth? Let me answer by saying that we expect a reactivation of the Chinese economy for the US and for Europe, less growth than in 2023 and 22, so flattish. The bad year in economic terms for China was 2022. And we now have the advantage of a reactivation, which is a result of this reopening and a very strong consumer sector. Now, in China, this is a lesser percentage of activity than in other economies. Nicolas said 70%. That is the weight of consumption in the U.S. Consumer activities. In China, it's 50, 55. So there are other segments that are very important for growth in China. And in that chart, we can see a variable which is a source of concern, the negative evolution of investments in real estate. This had been an engine over the past few decades in China, but it had actually resulted in a huge leveraging in construction companies, and the government imposed very strict rules. So our positive outlook, yes, growth in China, but we have to also take very much into account how Chinese authorities will successfully stabilize the real estate sector, which is so important in China. Well, thank you. And bearing all of this in mind, I have a 2-minute question for each one of you, Alfonso and Nico. What about central banks, the Fed and the European Central Bank? The question is it possible that there will be shrinking rates before the end of December?
No. Well, the market is replying when it comes to price. It's been reacting to a fall of inflation, which we've been seeing with our inflationary expectations from April onwards. We expect to reach about 3%. The market before the meeting the Fed had, they expected a fall of 50 basic points by the beginning of this year. What Powell did mention was that inflation and rate growth, especially the labor market, its strength, he still believed that for 2023 we are going to keep interest rates as they are. Actually are what we expect from the plots we had from December, which is the consensus of all governors of the Fed, is between 5 and 5.25. So there's a difference of 50 basic points when compared to the market. And 2023, at the end of the day, is not related to how much it's going to grow. Our current levels are in a positive interest rate for this year, so they're pressuring all on financial conditions. So if there's an actual risk for the second half of the year, by reducing our interest rates, we could generate inflation, which is what happened in the 70s. That was the mistake we made. Powell has said throughout 2022 and 2023 that they don't want to make this mistake, and before changing their monetary policy, inflation will be anchored close to 2%, which is their goal. So overall, our summary is, if we have to position ourselves, if there is a fall, it would be towards the end of the year, by December or even the first quarter of 2024, insofar as current existing trends don't change. Okay, same question for you, Alfonso. What do you think of these European Central Bank? Do you think interest rates are going to fall, or what should happen for this to happen? Well, I agree with Nicolas, first and foremost, because the European world is lagging behind the Fed, and we're in an inflationary cycle. And last week, Lagarde was clearer than what they said in December, and they were focused on reducing tension, and we're focusing on second round effects and the impact. And the second component is salary overflow. And that's second of your questions. The European Central Bank wants to ensure that there is no salary overflow, and they won't see this until next year, until all union conversations are done. And once the ECB sees that this hasn't happened and that there's no salary overflow, and we're in the middle of the year, I think that come June, we should already certify this monetary pause. We're taking a look at an increase of 50 basis points by the end of March, which would lead us to 3%. And from then on, the market is debating if we will need much more, less, and how many movements we can expect. Maybe 50 additional basis points, which could be reasonable to be 3.5, and our intervention rate would be 4%. And then, just like in the States, we expect for the European Central Bank to open up a table of operations, a plateau of operations, and they will have a lot of guarantee to ensure that the process is successful, and they've been able to revert inflation for the coming months. So we don't expect for rates to fall until spring 2024, and this is a mistake that was criticized, but they might have reacted late, and we haven't thought so. They've managed to anchor inflationary expectations. I think that this is going to be the legacy some years down the line, so I think that it would be it would be bashful of us to repeat what we said. It would be brash of us, and I think that, well, we have to wait. And what we said in November, Jackson Hole this year, just like last year, they offered a lot more tension. I think that this year they're turning the screw to a monetary policy that will crystallize in spring 2024. And, well, I think that in these last few minutes, I would ask you to please, out of everything we've been mentioning these 35 minutes, could you please summarize very quickly for customers so they think, so they can remember the key issues that we've touched upon, and then we'll go to a Q&A session. Well, to summarize everything, I would offer 3 messages: 2 pros, 1 con. The first pro, interest rates and inflation. The monetary variable is being stabilized, and we are taking a look at how everything is being paused. And 2 out of the 3 P's we're seeing as key for market recovery are very close. We're very close to them, and it's very important for all interest rates and for all fixed income markets. Second pro, we aren't seeing a huge crisis. We see deceleration, and we are seeing some of the characteristics, and some of the most important risks have disappeared. So we have power in Europe. China has free movement, and, well, the market still shows that it's strong, and this eliminates the risk of a big recession. We're talking about a deceleration. And finally, the con, what should worry us? It's a misalignment between market expectations and the messages central banks are putting forth. Central banks are telling us that they won't change their monetary policy towards reduction of interest rates until there's an economic adjustment that allows us to strike a balance between a market that is actually under tension and that generates a lot of, that can pass this inflation to salaries, and the market believes that we can reach this with reduced economic costs. So we expect this misalignment between what the market expects and the messages. We expect that this will generate some volatility and that this will mostly affect equity markets. So I think that I would focus on these three messages. Okay, very good. So we have a question from the audience. Carlos, he's asking us, what do we expect as far as consumer trust levels? What do you think is going to happen with consumers? So, well, I think that Nico mentioned it earlier, the variable in the US, a lack of purchasing power. Well, it's always on a delay. And we're going to see this cumulative impact. And the positive aspects, I would say that overall the pandemic brought us this lockdown, but, well, it brought us a savings buffer, which, well, it is true that we've been spending it, but we still have much more than what we've seen in different cycles, and this should be something that calms us, and fiscal policy helps. And what we had at the end of 2008 and the next years is that fiscal policy was counter to everything. We wanted to offset monetary policy as counter-cyclical movements. Let's remember that the market was helping, and we've seen that we don't have to adjust. We don't have to touch that knob that much, and it should be much more flexible. And I think that this piece, it definitely is aligned with what monetary policy is doing, and it's an escape valve for consumers. And it's all going to depend, and this is what economists always say, if the labor market works, that's what consumers are calmest. When there's work, you can tighten your belt and you can make do without certain expenses, but the machine itself is going to keep on running. I think that that's what's going to be important. So I think that there are differences between, when compared with different cycles, saving, labor strength, and helping policy as a triple threat in this cycle. So I think that this will come, and I think that this will improve, and let's expect that this improves, and that is something that is much more unpredictable. Thank you very much, Alfonso. Nicolas, I want to ask you a question which the audience has asked. The question touches on equity. We haven't talked that much about markets, and I think that it's important for us to think of our position and what might happen in equity markets with such a strong start with a poor economic growth year. Well, this was more to be expected for equity to start so-and-so, and what can we expect? Is this going to remain? What's going to happen with profits? Well, very good question. Start of the year, for all of those who are interested in equity, you've seen that it's been a reflection of last year, what's worked best this year, and I think that the key dynamics haven't changed, and when it came to the results presentation shows that companies, especially at a margin level, are pressuring a lot on the low end, and everything is descending for the end of 2023. But at the end of the day, the market, based on this scenario, which is much more favorable towards growth and inflation, well, what we're showcasing is that companies, especially towards the second half of the year, will behave better. So they're trying to get ahead of the curve with this price growth, with these better expectations when it comes to results. And, well, this is what we've expected, especially when we compare to different EPS. And based on the idiosyncrasies of all markets, along with depreciation of the dollar, which has also favored good behavior, and insofar as this is a situation that at a global level is a deceleration, and that this fall doesn't accelerate, well, at the end of the day, I think that markets can bear the situation. You mentioned something. They're asking us about dollars. Yes, there was a very strong dollar throughout 2022, and now the dollar has weakened somewhat. What do you expect of dollars to happen throughout this year? Well, variables we've been taking a look at in 2022 has been geopolitical risks, which always favor the purchase of more defensive currencies such as dollars, and then monetary mass. And as monetary mass has accelerated in the last couple of years, such as the dollar, well, the dollar has depreciated, and that is something that we believe, insofar as everything is still growing, we should see the dollars and more geopolitics should keep on depreciating. And at the end of the day, the only factor which could have an impact on the depreciation of the dollar in the second half of the year is the maintenance. And maybe if it isn't listed, we have to think that the Fed, if inflation, this isn't our central scenario, but if it reaccelerated, this could open the opportunity of increasing interest rates, which would set apart interest rates from what we expect and to grow, and this would attract flow with dollars. And at the end of the day, continuous depreciation throughout the year. Okay, very good. Well, I want to thank all of you, Alfonso, Juan de, and Nicolas, for taking part in this talk. We had 40 minutes to update our global market outlook, and well, we hope that this was useful, and we'll see you in the next 12 talk. Thank you very much.